Something strange is happening in the Bitcoin market right now, and almost nobody is talking about it properly. In just about 1 week, whale wallets have quietly pulled in more than $1.2 billion worth of Bitcoin. At the same time, the big spot Bitcoin ETFs here in the United States just booked their strongest week of inflows since April, with roughly $754 million pouring in. BlackRock's IBIT fund alone grabbed close to $479 million of that in just 3 trading sessions. Normally, when that much money floods in from both whales and institutions at the same time, the price should be flying. It isn't. Bitcoin is sitting stubbornly around $64,000, boxed in below a wall near $65,000, almost daring someone to make the next move. So here's the real question. If everyone with serious money is buying, who on earth is selling hard enough to keep the price pinned down like this? And if we can figure out who that is, we might actually be able to see where Bitcoin goes next, before the rest of the internet catches on. But that is only the first half of today's story. Because underneath all of this, there is a bigger force at play, one connected to interest rates, jobs data, and the Federal Reserve, that could flip this entire setup within a matter of hours. Stay with me, because by the end of this video, you are going to understand something about this market that most channels are not even mentioning right now. Before we go further, quick disclaimer. Everything in this video is for educational and informational purposes only. This is not financial advice, and nothing here should be treated as a recommendation to buy, sell, or hold any asset. Markets are risky. Always do your own research, and only invest what you can genuinely afford to lose. And if you are new here, welcome to the Wealth Continuum. This channel exists to help you see through the noise in these markets and think a little more like the people actually moving billions of dollars. If that sounds useful to you, sticking around for this one is worth it. Now, quick question before we dive in. What are you doing while you're watching this? Working out? On a lunch break? Lying in bed scrolling? Drop it in the comments. I genuinely like seeing where this channel reaches people. And hey, how's the weather where you are today? Some of you are in the middle of summer heat. Some of you are already seeing the first signs of autumn. Let me know below. Let's lay out the contradiction clearly, because this is the whole engine of today's video. When whale wallets accumulate aggressively, prices usually move. When exchange reserves fall because coins are being pulled off into cold storage, prices usually move. When institutional ETF demand picks up at its fastest pace in months, prices usually move. Right now, all 3 of those boxes are checked, and the price is basically flat. Ask yourself this. What kind of force could possibly absorb over $1.5 billion of combined buying pressure without the price breaking out? There are really only a handful of honest answers to that question, and one of them barely gets discussed on crypto YouTube at all. We are going to walk through every single one of them today, so you're not left guessing like everyone else scrolling through their timeline. But here's what they're not telling you in most of these breakdown videos. This exact kind of quiet, boring, sideways price action has shown up before major moves in previous cycles. Boring is not always what it looks like on the surface. Let's get into the actual numbers, because this part matters. According to on-chain data from Sandimint, wallets holding between 10 and 10,000 Bitcoin, the range, typically classified as whales and sharks, have accumulated more than 20,000 Bitcoin since July 29th. At current prices, that stash is worth right around $1.2 billion. That is not a random Tuesday of light buying. That is a sustained multi-week accumulation pattern, happening quietly below a price level most retail traders consider unremarkable. Here's the historical pattern worth understanding. Whales rarely chase green candles. They almost never buy euphoria. They buy confusion. They buy sideways chop. They buy the exact kind of price action that makes smaller investors bored enough to stop paying attention. If you look back at past cycles, some of the largest accumulation windows happened during periods that felt completely uneventful in real time. Nobody was making viral videos about them while they were happening. People only noticed afterward, once price had already moved. So here's a question worth sitting with for a second. If whales are buying this aggressively into weakness, who exactly is on the other side selling into them? We're going to answer that. But first, let's talk about the other major player in this story. Quick comment prompt for you. Comment below with just one word, whale or retail. Who do you think is actually right here? I'll be reading through these. While the whale story is unfolding on-chain, a completely separate story has been building through the regulated ETF market. U.S. spot Bitcoin ETFs pulled in roughly $754 million in net inflows over the course of this week alone, putting them on pace for their best week since April. That is a sharp reversal from June, when these same funds recorded their worst month since they launched. On a single day this week, Wednesday, these funds alone absorbed more than $240 million. BlackRock's IBIT product has been the dominant force, hoovering up close to $479 million across just 3 sessions. Here's what makes this genuinely interesting. Fund managers running these ETFs are not day traders. They are not reacting to a single tweet or a single red candle. When institutional money moves at this scale, it usually reflects a longer-term positioning decision, not a short-term emotional one. So picture the contrast here. On one side, you've got retail sentiment, which by most measures has stayed fairly cautious and hesitant. On the other side, you've got institutions quietly building exposure through a fully regulated product, session after session, almost without fanfare. Why would large professional money keep adding exposure into a market that refuses to break higher? Because, and stay with me here, there's a hidden layer to this market that most people never think about. This is where the story gets strange. If whales are buying, and ETFs are buying, and exchange reserves are dropping, somebody has to be supplying all of that Bitcoin. Coins don't materialize out of nowhere. Every single purchase needs a seller on the other side. So let's walk through the realistic possibilities. The first possibility is profit-taking from long-term holders. Some investors who bought years ago when Bitcoin was worth a small fraction of today's price are simply using this window to lock in gains, regardless of what whales or ETFs are doing. The second possibility is miners. Bitcoin miners regularly sell a portion of their block rewards to cover operating costs, electricity, and hardware expenses. That selling pressure is constant, and it does not care what the headlines say. The third possibility involves larger structural holders, including certain government-held wallets and corporate treasuries that periodically rebalance their positions for reasons that have nothing to do with short-term price direction. The fourth possibility, and this is the one almost nobody talks about, is the role of over-the-counter desks and market makers. Billions of dollars in Bitcoin can change hands through OTC channels without ever touching a public order book or producing a dramatic candle on your chart. A huge chunk of this market moves in complete silence. Here's the pattern interrupt worth remembering. Most people still picture Bitcoin trading exactly like a regular stock, with every big buy or sell instantly visible in the price. It does not work that way. Massive supply can be absorbed quietly, spread out over days or weeks, precisely so it does not spook the market. That single fact alone explains a lot of what we're seeing right now. Now let's zoom out, because crypto-only explanations only tell half of this story. Right now, the Federal Reserve is holding its benchmark interest rate steady in a range of 3.5% to 3.75%. As of this point in 2026, there have been no rate cuts at all this year, a sharp change from what many analysts were expecting heading into the year. That single fact changes everything about how risk assets, including Bitcoin, are behaving. Every upcoming jobs report, every inflation print, every comment from Fed officials gets dissected by traders looking for clues about where interest rates go next. A stronger than expected labor market tends to push back expectations for rate cuts, which tends to strengthen the dollar and pressure risk assets like Bitcoin. A weaker labor market tends to do the opposite, reviving hopes for easier monetary policy and often lifting Bitcoin alongside other risk assets. Here's the part that matters most. Sometimes Bitcoin isn't reacting to anything happening inside crypto at all. It's reacting to the price of money itself, to bond yields, to the dollar index, to global liquidity conditions that most people never think to check. This is exactly why Bitcoin can sit dead still even while whales are buying billions. The bigger macro backdrop is currently the tug of war deciding the next real move, not any single crypto headline. You need to understand this before we go any further because it directly shapes everything in the next section. Quick one for you. Do you personally think interest rates or whale buying will matter more for Bitcoin's next big move? Drop your answer in the comments. I want to see the split. Let's talk about timing because this is where whale psychology gets genuinely fascinating. Whales are not fortune tellers. They cannot predict exactly what a jobs report or a Fed statement will say next. What they can do is manage risk and prepare for a range of outcomes, scaling into positions gradually rather than trying to perfectly time a single headline. This is really a story about two completely different time horizons. Retail traders, generally speaking, want results tomorrow. They want the green candle today, this week, right now. Whales tend to think in terms of months, sometimes years, willing to sit through weeks of boring, directionless price action if it means being positioned correctly when conditions finally shift. That difference alone explains a lot of the frustration you might be feeling if you're watching your portfolio sit flat while headlines scream about billion-dollar accumulation. Here's a question worth genuinely sitting with. Could this current stretch of sideways movement simply be noise, the kind of quiet chop that precedes bigger decisions, rather than a signal that nothing meaningful is happening at all? Stay with me, because the next part is crucial, and it's where we start connecting every thread we've pulled so far into one picture. Based on everything we've covered, there are really three broad scenarios worth thinking through. Scenario 1, economic data comes in stronger than expected, reinforcing the idea that the Federal Reserve holds rates steady for longer. The dollar strengthens and Bitcoin dips in the short term. If that happens, expect whale wallets to likely treat that dip as another accumulation opportunity, continuing the exact pattern we've already seen since late July. Scenario 2, data comes in weaker than expected, and rate cut expectations for later this year start creeping back into the conversation. Liquidity conditions ease and Bitcoin gets the fuel it needs to attempt a real break above resistance, potentially targeting that measured move analysts have been pointing to, somewhere in the region of $76,000, based on the inverse head and shoulders pattern currently forming on the chart. Scenario 3, and honestly, this is the one that catches the most people off guard. The market whipsaws in both directions. Overleveraged traders get liquidated on both sides. A false breakout traps the buyers. A false breakdown traps the sellers. And right in the middle of that chaos, patient accumulators quietly add to their positions while everyone else is busy getting shaken out. Here's the retention hook worth remembering. This exact pattern, sharp uncertainty followed by a decisive move, has repeated itself across multiple previous market cycles. History does not repeat perfectly, but it rhymes often enough that it's worth paying attention to. Which of these three scenarios do you think is most likely over the next few weeks? Genuinely comment your prediction below and come back later to see if you called it. Let's tie this whole investigation together. Bitcoin has not exploded higher, not because real demand is weak, but because something else is happening beneath the surface. Available supply is being absorbed slowly, deliberately, by buyers who are clearly not in a rush and clearly not panicking about short-term price action. Here's the part that should stick with you. Markets like this cannot stay in balance forever. Eventually, one side runs out of coins willing to sell at current prices, or one side runs out of patience waiting to buy. When that balance finally breaks, Bitcoin has a long history of not drifting gently into its next move. It reprices, often quickly, often catching latecomers completely off guard. So the real question isn't really whether whales are buying. We already know they are. The on-chain data makes that completely clear. The real question is why they're comfortable buying steadily while retail sentiment stays cautious and the price refuses to confirm their conviction. That gap between what large holders are doing and what the price is currently showing is usually where the most interesting opportunities and the most important lessons in this market tend to live. Maybe the next economic report shifts everything within hours. Maybe it doesn't, and this sideways grind continues for another few weeks. Nobody watching this video, including me, can promise you which scenario plays out. But history has shown, again and again, that some of the most important moves in this market begin at exactly the moment everything looks the most boring on the surface. While most people are watching the price chart, refreshing it every few minutes, waiting for something exciting to happen, the more patient side of this market is watching supply, quietly, patiently, without needing a headline to justify their next move. Right now, that supply appears to be disappearing faster than most casual observers realize. If this kind of breakdown helped you see this market a little differently today, hit like. It genuinely helps this channel reach more people who are trying to actually understand what's happening instead of just reacting to headlines. Subscribe if you want more videos like this one, breaking down what's really moving behind these markets instead of just repeating the same recycled talking points everyone else is using. And if you know someone who's been confused about why Bitcoin isn't moving despite all this buying, share this with them. It might save them a lot of guesswork. This has been the Wealth Continuum. We'll be watching this setup closely, and we'll be back the moment something meaningful actually breaks. See you in the next one.